I need to start with the part that makes this harder, not easier. I am heavy in DVLT. So if you are watching this and thinking, okay, he probably wants the bullish version to be true, you are right. I do. I want this company to work. I want the stock to work. I want the big RWA platform vision to turn into actual revenue, actual cash, and actual per share value. But that is exactly why I cannot let myself turn into a cheerleader. When you own a stock, the easiest mistake is not being too bearish. The easiest mistake is defending the story after the facts start changing. And with DVLT, the facts are not simple. There is a bull case here. I still lean bullish. But there are real red flags, related party revenue questions, a huge gap between Q1 revenue and full year guidance, a messy financing stack, dilution risk, a Bitcoin transaction where the payment quality matters, and a lot of language like proposed, subject to, up to, target, intended, and definitive agreements still needed. That is not nothing. So this video is not DVLT to the moon. This is the video I would want someone to make if I were trying to audit my own bias. Here's the timeline. Here's why I still give Nate Bradley a chance. Here's why I think the market may be too skeptical. And here is exactly what DVLT has to prove next. Because for me, this is no longer a press release stock. This is a receipts stock. So I want to build the case that way. Not like a normal slide deck, like an evidence wall, press release filing, receipt. That is the whole framework. The DVLT story really starts when Nate Bradley took over. According to the company's management page, Nathaniel Bradley was appointed CEO and director on December 31st, 2024, when the company completed its purchase of assets from Datavault Holdings. The same page describes him as a co-founder and CEO of Datavault Holdings, and says he has more than 70 international and US patents across areas like blockchain, cybersecurity, AI, data science, mobile advertising, and internet broadcasting. That matters because DVLT is not just the old why say audio story anymore. This became a transformation story, and transformation stories are usually messy. The company still has acoustic technology. It still has why say related legacy pieces. But the center of gravity moved towards something bigger: data monetization, RWA tokenization, exchange infrastructure, patent licensing, AI agents, secure edge nodes, and specialized markets where real-world assets can become tradable digital assets. Now, I understand why that sounds exhausting when a small cap company says it is doing AIRWA exchanges, strategic minerals, advertising, NIL, Bitcoin, edge infrastructure, and licensing all at once. The market has every right to raise an eyebrow. That can be ambition. It can also be a warning sign. My job as a shareholder is to separate those two. The bullish interpretation is that Nate is not randomly chasing buzzwords. He's trying to build a platform where different asset classes flow through the same basic machine, identify the asset, verify ownership, score or value it, tokenize the economic rights, move it through a marketplace, and monetize the transaction layer. That is the cleanest version of the DVLT story. It is not just we do RWA. It is we want to own rails for turning hard-to-trade assets into financeable assets. That is why I keep paying attention. But the filings are where the story has to earn trust. So the first evidence card on the wall is simple. Nate changed the story. Now, the filings have to prove the story change for common shareholders too. Let me be fair to the bull case first. DVLT did report a major revenue ramp in 2025. In March 2026, the company reported Q4 2025 revenue of $33.8 million, Q4 GAAP operating profit of $4.2 million, fiscal 2025 revenue of $39.1 million, and it reiterated a $200 million full year 2026 revenue target. That is why I do not dismiss DVLT as empty. There was a revenue ramp. There was a reported profitable quarter. Management did not just talk about a future business. They put numbers on the table. But this is where bulls have to be honest. The revenue quality was not clean enough for me to say, okay, case closed. The 2025 10K discusses Vivasor as a related party and says DVLT recognized $20 million of revenue from Vivasor. It also says no royalty revenue had been recognized from Vivasor, and that accounts receivable from Vivasor totaled $20 million at year end. The same 10K says DVLT recognized $10 million of revenue related to Scilex, with accounts receivable from Scilex totaling $10 million at year end. So if someone says the 2025 revenue ramp had related party and receivable issues, I cannot call that FUD. That is in the filing. This is where I think some bulls make the wrong argument. The argument should not be the red flags do not exist. They do exist. The stronger bull argument is different. The stronger argument is 2025 showed that the company can structure large commercial arrangements. Now 2026 has to prove those arrangements convert into cash, third-party revenue, higher margin, and per-share value. Now, that is the distinction. I am not buying DVLT because 2025 already proved everything. I am still interested because 2025 created a foundation, and 2026 is the year that foundation either becomes a business or gets exposed as too promotional. That is why this quarter matters so much. So the second evidence card is not green or red. It is amber. Real revenue ramp, messy revenue quality. That is the honest label. The Q1 2026 numbers are the tension point. In the Q1 2026 business update, DVLT said it had more than $800 million in tokenization contracts signed, generating nearly $100 million in fees expected to be recognized in 2026. The company also reiterated the $200 million full year revenue target. That sounds huge. But then you look at the actual Q1 financials. Revenue for the 3 months ended March 31st, 2026 was $3.4 million. Gross profit was only $100,000, or about 3% of sales. Net loss attributable to common stockholders was $53.1 million. Net cash used in operating activities was $8.7 million. And common shares outstanding went from about 573.4 million at December 31st, 2025 to about 617.8 million at March 31, 2026. That is the problem. You cannot casually wave that away. If a company is targeting $200 million in full year revenue and Q1 starts at $3.4 million, the back half has to do a lot of work. The bull response is that DVLT is not a normal, smooth subscription model. Revenue could be lumpy. Licensing revenue can hit in chunks. Tokenization fees can be recognized around milestones. Acquisitions can change the base. Large platform deals can distort normal quarterly cadence. All of that may be true, but lumpy is not a blank check. If the revenue is lumpy, I need to see the lump. If the contracts are real, I need to see recognition. If the platform is commercial, I need to see customers and cash. Q1 did not kill the bull case for me. But Q1 did remove the luxury of patience. This is now a Q2 and Q3 proof story. If revenue is lumpy, show me the lump. That is the next card on the wall. I want to slow down here because this is where a lot of small cap investors get hurt. Revenue is not the only scoreboard. Per share value is the scoreboard. DVLT can grow revenue and still hurt shareholders if the share count keeps expanding faster than the business. In Q1, the company disclosed roughly $30 million of proceeds from issuing shares through an at-the-market program. It also disclosed the jump from 573.4 million shares outstanding at year-end to 617.8 million shares outstanding at March 31. That does not automatically make the company bad. Small companies often need capital. If the capital funds acquisitions, platform development, strategic transactions, and revenue conversion, dilution can be a bridge. But if the capital only funds operating losses, fees, and more headlines, dilution becomes a treadmill. That is the difference I'm watching, capital bridge or dilution treadmill. That is the question. And because I own shares, I care about that more than almost anything else. I do not just want a bigger DVLT company. I want a bigger claim per share. If the business becomes real, but the per share economics get eaten by dilution, common shareholders do not win the way the headline suggests. So when I say I lean bullish, I am not saying dilution does not matter. I am saying dilution is one of the main things that will decide whether the bullish thesis survives. This evidence card is the one I think retail investors skip too often. Revenue can grow while your slice shrinks. That is why the denominator matters. Now, here is why I am still bullish despite those issues. When I look at the timeline, I do not see a company that only issues disconnected headlines and disappears. I see a company trying to stitch together the operating pieces of a platform. API Media is one piece. In January 2026, DVLT announced that it had closed the acquisition of API Media Innovation, describing API as a provider of media infrastructure and event technology solutions, and saying the deal extends Datavault AI and patented ADO technology into live outdoor event markets. That matters because it gives DVLT something more physical and event-driven, not only abstract. RWA language, NYIAX is another piece. In March 2026, DVLT announced a definitive agreement to acquire NYIAX, describing NYIAX as a blockchain-enabled exchange platform built on financial market infrastructure, and saying the combination was intended to support institutional-grade digital marketplaces. That matters because RWA does not work without market infrastructure. You can tokenize something all day long, but if nobody can price it, trade it, settle it, verify it, or trust the marketplace, the token is mostly decoration. That is why NYIAX is important to the bull case. It is not just an acquisition headline. It is the exchange layer. Then there is the edge node plan. In January 2026, DVLT said it expected to have more than 100 nodes across 33 cities, generating revenue in the second half of 2026. And it tied full deployment across 100 plus cities to a 2027 revenue target of $2 billion to $3 billion. I do not treat that as guaranteed. Let me repeat that. I do not treat a $2 billion to $3 billion 2027 target as proven. But I do treat it as a clue about what management is trying to build. They are not describing a small consulting business. They are describing infrastructure. That is why the upside is so large if the receipts show up. And that is why the downside is painful if they do not. So this is where the board starts to fill in. API is not the whole thesis. NYIAX is not the whole thesis. Edge nodes are not the whole thesis. But together they start to look like pieces of the same machine. That is what keeps me interested. Now we need to talk about Helmex. This is one of the most important and most misunderstood parts of the DVLT story. In the June 4th 8K, DVLT disclosed a non-binding term sheet, except for certain provisions, related to a potential $2 billion structured financing transaction. The structure was described as 4 successive tranches of up to $500 million each. The same filing says the company had a binding obligation to make a non-refundable $25 million payment no later than June 4th, 2026 to fund administrative, operational, and structuring-related costs connected to the first tranche. It also says DVLT may issue shares at a purchase price of $1.55 to $2 per share in exchange for preferred units in an investment vehicle valued at approximately $2 billion. That sounds bullish if you only read the headline, but the filing includes a lot of conditions: due diligence, definitive agreements, stockholder approval, regulatory approvals, potential authorized share increase, fairness opinion, transaction fees, independent valuation. And the filing explicitly says there can be no assurance definitive agreements will be executed or the transaction will be consummated. It also flags possible dilution from issuing shares representing more than 50% of current outstanding voting capital stock. So my view is very specific. Helmex is not $2 billion of cash in the bank. It is not a completed financing. It is not safe to model as if the money already exists. But it is also not irrelevant. If DVLT can turn even one tranche into a real balance sheet asset that can support financing, collateral, acquisitions, or platform rollout, the market may have to take Nate more seriously. That is why Helmex is a swing factor. It could be transformative. It could also become a red flag. If the payment trail is unclear, the preferred units are hard to value, the deal gets delayed, or dilution arrives before proof. For me, the next filing has to answer a simple question. What did DVLT actually get for the $25 million obligation? Not vibes, not a press release, the accounting trail. Until I see that trail, the Helmex card stays amber, potentially huge, not proven, not cash yet. The June 29th Scilex Bitcoin 8K is another example of why I am bullish, but careful. The filing says DVLT entered into a binding term sheet with Scilex for Silex's proposed purchase of Bitcoin held by DVLT in a Biconomy digital wallet. It says Scilex is expected to purchase 837 Bitcoin for $50 million, with an initial $30 million payment and the remaining $20 million payable in quarterly installments from Q4 2026 through December 31st, 2028. That sounds like a liquidity win, but the payment quality matters. The same filing says Scilex may pay the purchase price in cash, Scilex common stock, publicly traded securities of Scilex subsidiaries, or a combination at Silex's discretion. So I cannot call this the same as $50 million of clean cash. It might become helpful liquidity. It might reduce some balance sheet pressure. It might be better than dumping shares into the market. But if the payment is mostly stock or securities that have their own liquidity and valuation risk, then shareholders need to understand that. This is exactly the kind of thing that separates a serious DVLT analysis from hype. The bullish version is DVLT monetizes Bitcoin, avoids worse financing, supports near-term cash needs, and buys time for larger platform deals to convert. The cautious version is DVLT still needs liquidity. The payment is not necessarily cash, and the deal does not by itself prove operating revenue. Both can be true at the same time. That is why I call it a cash quality test. Not bearish, not automatically bullish. A test. That is the evidence card label. $50 million headline. Payment quality unknown. The latest piece that really caught my attention is Patriot Strategic Metals. On July 1st, 2026, DVLT announced a proposed strategic partnership with Patriot Strategic Metals to jointly develop the Strategic Materials Acquisition Platform, or SMAP. The release describes SMAP as institutional digital infrastructure for financing, tokenization, settlement, and lifecycle management of strategic mineral assets. This is where the DVLT story gets more interesting to me, because I do not think DVLT has to beat BlackRock in tokenized treasuries. That is not the lane. The better lane may be harder to tokenize assets where specialized rails matter. Strategic minerals, data rights, advertising inventory, NIL, IP, event data, digital twins, commodity-backed finance, and other assets that do not fit neatly into the traditional financial system. That is where a smaller, patent-heavy, aggressive company might have a shot. The Patriot announcement is also specific enough to matter. The release says Phase 1 contemplates up to $700 million supporting trade finance, digital settlement, technology integration, compliance, and platform deployment, with up to about $62 million allocated for DVLT-related technology integration, digital RWA, infrastructure licensing, platform development, and implementation activities. It also says DVLT would participate in 25% of net distributable platform profits unless otherwise agreed for a specific transaction or SPV. That is not a tiny headline. But again, we have to read the conditions. The same release says the proposed strategic partnership and Phase 1 program are subject to financing availability, execution of definitive agreements, board approvals, applicable regulatory requirements, commercial deployment, and other conditions. So I am not putting $700 million in revenue. I am not putting $62 million in booked revenue. I am not treating 25% profit participation as proven cash flow. So what I'm saying is this. If DVLT is going to matter in RWA, this is the kind of asset category where it might matter. Not the cleanest asset, not the easiest asset, the messy asset where financing, custody, certification, compliance, and settlement actually create pain. That is where rails can become valuable. This is the first card on the board that I would mark green amber. Green for strategic fit, amber for execution risk, because if DVLT has a real RWA lane, this is the kind of lane where I think it makes sense. So after all of that, why do I still lean bullish? Because I think the market is treating DVLT like the only possible outcome is failure. And I am not there. I understand the skepticism. I even share part of it, but I do not think the timeline is empty. Nate took over. The company changed direction. Revenue ramped in 2025, even though the quality needs scrutiny. Q1 was weak against the full-year target, but the company still pointed to signed tokenization contracts. API closed NYIAX, moved to a definitive agreement. The 100-city plan gives the story an infrastructure frame. Helmex could be a balance sheet swing factor if it closes cleanly. Scilex could provide liquidity if the payment quality is real. Patriot gives the RWA story a more specific strategic minerals lane. That is enough for me to give Nate a chance, not a blank check, a chance, and that is the difference. I do not own DVLT because the company is already clean. I own it because if even part of this platform converts into revenue and cash, the current skepticism could be too extreme. That is the bet. The market is asking, where are the receipts? My answer is exactly. That is the right question. But I am not ready to assume the receipts never come. That is my real opinion. I am not defending every headline. I am saying the case board is full enough that I want to keep watching the next filing. And because I own shares, I am watching it harder, not softer. Here is the scoreboard I am using now. First, Q2 revenue. If Q2 is still tiny, the $200 million target becomes much harder to defend. It may not be impossible, but the burden of proof gets much heavier. Second, gross margin. If this is really platform, licensing, tokenization, and software economics, I do not want to see Q1 style gross margin forever. Third, cash collection. Revenue that turns into receivables is not the same as cash. I want to see collections. Fourth, related party mix. I want more third-party commercial revenue. I do not want the story to keep leaning on affiliated or related party arrangements. Fifth, Helmex accounting. If the $25 million obligation was paid, I want to see what asset or expense shows up and how management explains it. Sixth, Scilex payment quality. Cash is different from stock. Stock is different from subsidiary securities. The mix matters. Seventh, Patriot progression. I want to see definitive agreements, financing availability, actual platform milestones, and eventual revenue recognition. Eighth, NYIAX, closing and integration. A definitive agreement is good. A closed acquisition and functioning exchange layer is better. Ninth, share count discipline. This is the one I will not ignore. If the business improves, but dilution keeps outrunning progress, the common stock thesis gets weaker. That is the scoreboard. Not slogans, receipts. This is the part I want viewers to remember after the video ends. Not the biggest number, not the loudest press release, the scoreboard. I want to be clear about what would make me more bullish. Clean Q2 revenue ramp, better gross margin, visible cash collection, more third-party revenue, a clear Helmex accounting trail. Scilex payment quality that is actually useful, NYIAX closing progress, Patriot moving from proposed framework to signed economics, and share count discipline. If I see those things, I get more bullish. Not because the story sounds better, because the evidence gets better. Now, here's what would worry me. Another weak revenue quarter, more revenue sitting in receivables. Most revenue still coming from related or affiliated parties. The Helmex payment disappearing into vague language. Scilex payment mostly in securities without clear liquidity. A Patriot staying only as a press release. NYIAX, delay or failure to close. And dilution continuing faster than commercial proof. If that happens, I have to respect the bear case. I do not get to say I am bullish forever just because I started bullish. The filing has to keep earning the thesis. So here's my final view. DVLT is not safe. DVLT is not clean. DVLT is not proven. But DVLT may be one of the more asymmetric small cap RWA and data tokenization bets in the market. That is why I am still here. I am heavy. I am biased. I want Nate to deliver, but I am not blind. The bull case is not that every headline is already revenue. The bull case is that Nate may be assembling the pieces before the market believes him. Patents, data monetization, exchange infrastructure, strategic minerals, edge nodes, event and media assets, structured financing, and liquidity management. That is the upside. The risk is that the pieces never convert into clean cash and common shareholders pay for the ambition through dilution. That is the downside. So my thesis is simple. DVLT is priced like Nate will fail. I think the timeline gives him a real chance to prove the market wrong. But Q2 and Q3 need receipts, revenue, cash, margin, third-party validation, share count, discipline. That is what I am watching. Bullish but conditional, heavy but not blind, and from here, every filing matters. If you own DVLT, the question is not just what is the next press release? And the better question is, what turns into cash, revenue, and per share value? That is the scoreboard. And that is what I will be tracking next. Research only, not financial advice.